Patrick, now I'm going to put you on the spot since you can afford to be on the spot, having just made a fortune in both directions on this trade. For someone with my views, which is, look, I obviously the battle is over. We're very much momentum is now up with this 90-day ceasefire. I want to wait out this giant sigh of relief bounce that's now underway in markets. But whenever we get to a point of a top on this sigh of relief here, I want to figure out how to hedge and fully hedge my risk. And I don't mean just against the next little whipsaw that might come in the next week or two. I'm talking about putting on a hedge that will protect me from what could be several more of these events in coming weeks and coming months. I'm hesitant to again use put spreads, mostly because they don't fully realize their potential until just before expiry. Because of the time value still on my put spreads, I ended up only realizing about 2/3 of that difference, even though the market was trading several hundred points below my lower strike. So, and people who understand options understand why that's the case. So I think it's outright puts. Well, gee, I think outright puts just got a whole lot more expensive here. So, Patrick, give me an upside target on the S&P for where you think I should start scaling into a new basket of downside hedges. And tell me, in professional investor terms, how to best structure a hedge now that the jig is up and I'm obviously no longer likely to have the opportunity to buy E-mini S&P future puts at implied vols in the teens like we had the chance to do when you first recommended it to our Macro Voices listeners.
Those are all great questions. So let's break this down. First of all, what are the levels we should be looking for? Well, the interesting part is we already hit some of the upper levels that we were originally expecting this market bounce to go to, like the 5,500 to 5,700 area. I mean, can the market go to 5,800? For sure it can. But generally, once we're in that 55 to 5,700 zone above on the S&P, those are all levels where once again it becomes tactical to be considering new hedges. The type of hedges that we put on is going to be very reliant on where we are in volatility. And right now, with the VIX still up in the 30s, it is very challenging to just buy a straight out put option like you were suggesting. And you were also talking about some of the downfalls of using spreads. Well, there's a couple considerations when hedging with spreads. One, do you decide that you want to hedge for your return at end, which is that you're willing to hold the spread till its expiration, in that it will be in the money and that intrinsic value will be captured as a way of reducing the overall losses you're incurring on other investments. But when you're being tactical with the intention of closing the spread halfway through at a moment when the market hits a particular target, like you suggested, you are a point where you're not realizing the full profit potential of that spread. And that's normal. So one of the things that I often do is that if I know that I'm going to be tactical about a spread hedge, then I estimate what will be the profit of that spread when those target levels are being hit. And if I feel I need more hedge, then I'll just simply buy more spreads to ensure that your total dollar payoff at a tactical time is what you were originally targeting. Now, overall, this environment still is one where spread trading is a more tactical way of approaching your hedges, especially at these elevated levels of volatility. But it's not just volatility, it's also the skew. We have a very steep skew in the markets where those really far out of the money puts are paying rich premiums, making the spreads usually have very good payoff profiles. One of the things you can do is simply widening the spreads even further. Rather than, let's say, doing a 500 S&P point wide spread, you might end up doing 700 or 800 point spread to allow there to be more room for intrinsic value to be built, and you're often not sacrificing a lot in widening that spread because of the steepness of that skew. And so this is where I still think the spread trades are a way to go. Now, if you want all of the downside gamma of a protective put, then the alternative is that you go back to a collar strategy like we talked about, selling call premium in a way to help finance the cost of the downside put hedges. It's a way of offsetting some of those costs. And in a period where if you are in the mindset that this isn't over and that there's more vulnerability to the markets, then selling some of the upside away, especially after a huge rally like we've seen, is something that may be acceptable to many investors. Lots of really different ways to approach it, but I would say as we get here in the next week or two to levels on the upper end in that 5,700 give or take area, is a level where it does make a lot of sense to re-engage hedges going into the summer. Now, I wanted to quickly look at the charts on page 2 here, Eric, and wanted to show that the S&P 500 bounced right off of that 5,000 level, right at the level where we highlighted for members just last week. Now that we've got this bounce in the market approaching that 50-day moving average up above and the Fibonacci retracement zones, this is going to be a level where once again we should see the market start to struggle with overhead resistance and be far more trade range bound. Now, while I don't see a huge upside in the market, it is also likely that we could spend weeks grinding up here, and that the most immediate downside risk is not as highly probable, and because just the market is so exhausted from the selling and having discovered all these lower levels, it often spends time consolidating these things in. And so we'll be looking for where and how far this rally goes to project out where are some of the further downside targets going into the summer if this does end up being something much more like a bear market. On page 3, I have that volatility index, and one of the things that spurred me to profit take when I did was the huge spike in volatility. We have not seen a spike of volatility of this magnitude since COVID, and then you have to, before that, go all the way back to the financial crisis. The type of volatility spikes was extraordinary. Typically, this is that fear moment in a market where short-term lows are established, and the VIX really this time around did help identify that very moment. And so I think that there's a very good chance here now that volatility could consolidate back into the 20s. But one of the things that will be a big tell for me, Eric, is whether or not volatility consolidates in the 20s or whether or not we go back into the teens. Because if we see volatility go all the way back under 20 down to the 18 or 19 or something like that, then that would actually increase the likelihood that a major low could be in and that the market is pivoting. But if we see sustained higher levels of volatility where the market is rallying even for several weeks and just holding up at these zones, but volatility stays at 25 or 27%, then that tells me that that there's a lot of nervousness in the market and volatility premium is staying high for a reason. And that would be a bit of a warning for me.